Multifamily can make you rich, but it can also break you. So let's talk about the side that no one warns you about. If you are fearful of losing thousands of hours of your time, if you are fearful of losing $60,000 or more on this multifamily journey of yours, then what you're going to have to do is listen up to today's episode, because what everybody tells you is all the wins. You see it on social media all the time. Everybody winning, everybody doing epic closing deals, making so much money. But what listeners of mine don't always get is the truth about multifamily investing. So it's not really for everybody. And that's okay. You have the ability to get rich through multifamily real estate, but there's also the ability to lose a lot of money and other resources like time, as I mentioned before, because it is a very hard game to play if you're not 100% dedicated, especially if you have a W-2 a job like I do. You cannot dedicate that much time, especially if you have a family, especially if you have a side hustle like I do. There's so much to do, so much energy that needs to be put into this game. And if you're not ready for it, don't do it. But if you are ready for it, stick to the end and I'll give you a big fat kiss. How about that? Okay. No money, no problem. So that's misleading, guys. You need capital, credibility, or connections, ideally all three. But if you don't have capital, credibility, connections, then you got to have something, right? So you're going to be putting sweat equity in somewhere. So if you don't have the capital, you're putting in sweat equity with the connections of the people that you know. You're going to have to gain credibility over time, which takes a really long time. Okay. So what about syndications versus JVs, creative financing? And does it actually work for beginners? Well, let's talk about it. If you don't have any money, you can syndicate a deal and pool capital together, but you're not supposed to. Syndicators, people who syndicate deals, don't make much money if they don't put money in. The purpose of syndications is to buy something that is bigger than what you would normally be able to purchase on your own. So you're still putting in capital. Most general partners should put in around 10% of the total capital raise. And it's really obviously it's up to the general partner's discretion and their current resources or whatever. But if you are a brand new investor, have never done any deals before, and you're going to jump into syndications and manage everybody's funds and money, I mean, and be brand new as an operator, that's just a recipe for disaster. You're not going to make money through a syndication necessarily. It's very challenging to beat the preferred return that we all have to offer the limited partners, to go above and beyond the preferred return if you have no money in the deal and then get some returns yourself. It's going to be very minimal. Trust me. I mean, let's just think about it. Let's say you give a 7% preferred return. And after 5 years, that you hit that 7% preferred return. So anything above that, you're going to then split 70-30 with the investors, or 30 for the general partners, 70 for the limited partners, right? I mean, it's not huge. Like, what if you have an extra couple $100,000? So you're going to split up, let's say, $60,000, right? And that's between you and your entire general partnership team. And it also depends on how much equity you have in that 30% split, right? Let's say you have 10% of that 30%. So you're going to split up $60,000. You get 10% of that at $6,000, and you're going to get taxed on it. So you just worked 5 years to get $3,000. Is it worth it? And that's a risk. Most operators don't beat the preferred return, especially in today's day and age. So just be careful. Next option for people with no money, while creative financing, it definitely works. You can do seller financing. You can have no money down if you work with the right seller. But at that point, you have to have a very established relationship with that person for them to trust you in a situation like that. Or you take a risk and overpay and say, I'm not going to put any money down, but I know that in 5 years, I'm going to balloon this thing to the price that you want, and I'm going to get you your money back. It's risky. Like, why would you do that? Right. So we have to think about what really is happening behind the scenes here. The way people are getting deals done is the more experienced operators are syndicating their deals if they're choosing to syndicate, because a lot of them are also JVing, which we're going to get to in a minute. They're syndicating their deals and they're bringing on capital raisers to do the capital raise for them. So people are saying, oh, I have general partnership in this deal and I have 2% of the general partnership because I brought in $500,000, which is pretty standard. Okay. Now you get 1, 2, 3% max for being a capital raiser, guys. It's just the way it is. So if you don't put in any money and get the limited partnership returns on that syndication, and you're just a capital raiser, and you're really not doing anything but sitting and waiting for a preferred return to be beat, and then you maybe get a tiny portion of it. Remember, 2% of the 30% after, above and beyond. It's just, you got to really work the numbers, guys. Is it worth it for you? Because you got to put time in. And it's a reputation thing as well. If you're raising capital and the deal goes south, you just lost those investors, perhaps at least for the near term, but perhaps for life. So just be careful. Let's talk a little bit about JVs. So JV structures are excellent. And again, you could do the same thing. You don't necessarily have to have money, but it is optimal to have money, because the other way to gain, the other way to get returns through a JV or a joint venture, if you're not putting any money in, is to take 10-20% of the whole deal, which is wonderful. But you have to find partners that are willing to do that. So how are you going to make money on a JV structure? Let's say you have 20% ownership in the JV, meaning you negotiated with your partners there. You found the deal, you got some capital partners in, and you're going to manage everything. You're going to do everything. You now own 20% of this deal. Okay. Let's say it's $1 million deal. You own 20%. And right, there's equity in there, which we didn't discuss in the syndications, but like through a refi or sale, if you beat the numbers, you're going to get a small portion of that equity that you built up over time. But let's get back to the JV scenario. So you earned, let's say your $1 million property is cash flowing and returning 5%, which is pretty good these days, guys. So we're going to say 5% cash on cash return. Now let's imagine you had, at $1 million purchase, maybe there's $300,000 invested. So a 5% cash on cash return would be $300,000 at 5% year over year. So that would be $15,000 for the year. So now you have 20% ownership in the joint venture structure, and you also structured it where you're going to collect 20% of the distributable income. So what's 20% of 15,000? I believe it's $3,000. So you just made $3,000 in cash flow for the year. Is it worth it? You really got to work on this, guys. Guys, there's a lot of prestige and I like hype behind being a multifamily apartment building owner, but you got to make sure you really want to do it. Also, cash flow is minimal these days, with expenses being insane, vacancies up across the United States, CapEx surprises that come with all properties, little repairs and maintenance that add up. Guys, so cash flow at 5% is actually really good. And you might not even hit that. You have to understand that you might not hit that. That's number one. And number two, you don't live off of cash flow. Cash flow, you have to think of a property that is cash flowing as a hedge against risk, because there's obviously always going to be risk. But as long as the property is cash flowing, you should not have to reach into your pockets for something. And as long as you have a good reserves account and some CapEx funds built up, you should be okay. Let's now also talk about the workload involved. Guys, gals, this is not passive. This is not a passive job. Asset management, operations, dealings with tenants, if you're taking on that role, actively deal finding, actively recreating your pro forma, always negotiating for better rates with lenders, with insurance brokers, paying taxes, closing the books at the end of every month, writing investor summaries and investor updates if you have a syndication, or at least at the very minimal, you're having conference calls with your partners once a week or more to be discussing what's going on, to see where you can pull levers. And guys, I have to tell you, it is way more work than you think. You think, oh yeah, I'm just going to own this property. But what if like you have a 6 a.m. call and you don't feel like waking up? You got to do the 6 a.m. call. What if it's dinner time for your family? It's 7 p.m. and you got to do it. You have to take these calls. You have to make sure that your property is doing well. So like, it's one thing to go out there and buy a deal, which is honestly, I think, and acquisitions are crazy. First of all, in order for you to actually get to the finish line and actually close, I think it is insane, and not everybody's cut out for it. And I do that. It's very different than operating the deal, because once you're operating the deal, now you have people's money involved, whether it's yours, your partners, or your limited partners. You have people's money at risk and at stake that you have to handle and make sure is performing properly and actually beating the standards, beating the market. So take a step back, think about it for a little bit. Broker and seller games. Guys, brokers don't take newbies seriously. And I tell you how to gain credibility. I have a whole credibility kit that I have on my website right now. You can click smallxcommunities.com. I give you a video of how to create your own one pager, which is great for getting credibility with brokers, and a bunch of other resources that give you credibility with brokers. Now, sellers, on the other hand, once you do start negotiating and engaging with brokers, sellers hide property issues. And it's hard to spot those red flags. Even if you go through the due diligence period with a great inspection, okay, you got to be very careful. And from LOIs, guys, you get a signed LOI, you might think, oh, yeah, the game is over. We got this. Well, a buddy of mine had an LOI signed. The lady went ghost. She wasn't talking to him. It was like a month. And he was like, all right, the LOI is going to expire in a week. He finally got in touch with her and she said, oh, for the $6 million property, I need $3 million more. And that's how I'm going to get the deal done. The deal fell flat. He was actually ready to sell his house. He had somebody to buy his house. He was going to move, buy a new house. And this is what happens, guys. LOIs to contract, and then there's negotiating in between. It's just a lot that goes on. You got to be ready for this stuff. If you're not ready, don't do it, or invest as a limited partner. It's totally cool. And that's where all the returns go for syndications. They go to the limited partners. We don't get any as general partners unless we put money in. So know that. All right. Let's talk about the emotional component. It's an emotional roller coaster, guys. Deals fall apart more often than they close. Again, I underwrite 100 deals to maybe get one, and you get close on a few and you negotiate for a few. Imagine that. There's a lot of stress involved with that. There's financial risk. Sometimes you have to go do an inspection and it could be $1,200, $2,000, and you got to pay for it. And then you don't even go through with the deal. It's money under the bridge. And then there's partnership tensions. So when you are negotiating deals and looking at deals and partners are like, no, we need to make this deal work. And you're the underwriter, you're like, well, it doesn't work. What are we going to do? We need a deal this month or else I'm going to lose this money or whatever it is. I have somebody that needs to place $100,000. Okay, deals don't always work out. Or let's cover this up somehow. No, we don't do that. We're ethical. So there's a lot of stuff that goes on behind the scenes. But persistence is the number one factor that separates winners from quitters, guys. And you need to know this. You're going to take your hits. You're going to take your licks. You're going to get punched in the face. You're going to fall down a lot. And that's okay. Those people that stick with it are the ones that are going to actually get deals. Now, your first few deals might not be amazing, and that's okay too. Because what if you get 3 or 4 or 5 or 10 deals after that that are amazing? That is where your life can start to change. Be a freshman. Let's jump into this game. But know that you're going to be a freshman. Know that you're going to get beat up, and know that you're going to stick around so that you can win in this game. If you're willing to push through this, guys, this will change your life. Who is this game for? And who should stay out? Well, this game is for those people that are not going to quit, that understand that this is a 10-year process at minimum, and that are willing to get punched and get right back up. This is not for people who just want to do this an hour a week. This is not for the people who are not totally dialed in and always on their game and listening to the latest news and following everything and all the trends that are going on. This is not for you. If you are serious, here's how to prepare you before diving in. You can go to my website, like I said. You can get the broker credibility kit. You can listen to my past episodes. You can give me a phone call. I have my new underwriting tool, which is almost ready to go, guys. Maybe 3 more weeks, and that will be ready for you. And I'm going to give a ton of lessons for that to help you out. Speak with mentors. Speak with people that might be able to guide you in the right direction. And yeah, we get overexcited and we just want to close a deal. We want to get involved in the game. Take a step back. Think about yourself 10 years from now. Think about what you need to do to get to the spot where you want to be 10 years from now, whether that be underwriting 10 deals a week, or if you're going to take the lazy route, 1 deal a month, and you're not going to get anything. Make sure you're dialed in, guys. Make sure you know everything that's happening in this game and in this market and in this industry, and go out there, crush the deals, go be that epic operator that I really want you to be. I just had to lay down a little bit of caution for you today. I love you. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.